Hey guys, this is Joe Danso here with Donovan Financial Group, and in this video we're going to break down the different types of permanent life insurance that are available to you. Before we get into the types of life insurance, I think it's important to understand the basics. In this chart you should see at the bottom a timeline. So it should start from 0 to about 100, and then there's a line that constantly goes up. This is the cost of insurance rising, and life insurance is based on age, health, and the face amount, which is the death benefit amount that gets paid out once, just in case something happens. Now, two things you need to know about permanent life insurance is it comes in two. You have the life insurance, and then you have what we call a cash value. A cash value, you can think of it as an account attached to the life insurance, a savings account, whatever you want to call it. So in this segment, we're going to cover those two and what role they play within a permanent life insurance, right? So cash value has an interest based on the type of life insurance you pick. All right, you have the life insurance, you have the cash value. Now let's talk about the different types of life insurance available. Starting with whole life, oldest one out of all of them. Whole life means, the word itself says it all, it's for your entire life. Key thing to know about whole life is premium is fixed, and the cash value, the interest on the cash value is also fixed. So when you get the policy, they're going to tell you, okay, you will get a 3.5% annually. No matter what happens, whether that's Corona, whether there's a recession, it doesn't matter. The contract say 3.5 is what they're going to pay. And then you have the premium that's fixed, all right? So again, going back to that chart, look at the cost of insurance. All they do is they have actuaries do the math, factor in the cost of insurance that will happen over time, and with some other math that they do, they come up with the premium. With whole life, as long as you make the monthly payment or annual payment, policy will take care of itself, right? It's here to stay. So key thing to know about whole life is premium is fixed, cash value interest is also a fixed interest. All right, now let's move on to the next one. Next one is universal life. Universal life is also for your entire life. The difference between universal life and whole life is the premium is flexible. So in the chart again, you should see a minimum line, a target line, and a maximum line. What does this mean? So for a universal life, if you want the universal life insurance to do well over time, you want to stay around target or even above. We always suggest being above the target amount, okay? So you're paying the target amount in case, you run into some difficulties or you have some financial hardship, you can decrease the premium to a minimum and still maintain the life insurance, but eventually you will have to push it back up unless you're paying the maximum. Obviously, the maximum is there for people who choose to use the life insurance for other reasons, which we'll get into later. But you have that flexibility when it comes to universal life. Interest payments on the universal life is based on interest rates. So when interest rates are high, it might reflect on the account. If interest rates are low, as they've been for a while now, it will reflect on the account. So that's universal life. Next one in line is what we call variable life. Variable life is similar to whole life with the exception that this is actually an investment product, okay? So you have the life insurance, and then the company creates a separate account that's invested in the stock market. So market goes up, you participate in the gain. Market goes down, you participate in the gain. So that's variable life. Premium payments on variable is also fixed, okay? Fixed premium. So with variable universal life, it's very similar to variable life. Difference here is, again, the universal standing for the flexibility. So only difference here is the premium is flexible, okay? You have the target, the minimum, and then the maximum amount that can go into the separate account. But again, here it's also invested in the market. So if market goes up, you gain. If market goes down, you take the losses. So the last on the line is index universal life. Index universal life is pretty special. You have a floor, Usually the company will say they will give you a 1% floor. Most company will give you a 0% floor, meaning in negative years you don't get affected. The worst case scenario, you don't gain anything, right? Or if you have one of those that give you that 1%, you would gain 1% when there's nothing. But they also give you a cap as to how much interest you can get. And sometimes this cap might be 10, 12%, some may be higher, some may be lower, but they give you a cap. And how are they able to do this? The index, universal life, is linked, the cash value is linked to an index. So depending on the performance of that index, they credit to your account. Obviously, if the index does a 20% and your cash value cap interest is 10%, you will not get that 20%, you will just get a 10%. But if the index does have negative years, you don't have to worry about those losses. You just won't get anything, or you will get that 1%. So that tends to be very attractive to most people. That's why the topic index universal life becoming more popular and popular and popular. Now keep in mind that because it says index universal life, the universal, again, it means premium is flexible, as I've explained on the other similar products. But index universal life is not an investment product. Universal life is not an investment product. Whole life is not an investment product. The two products that will be considered investments are variable life and variable universal life. So those are the 5 different types of permanent life insurance that are available to you. For more information, join our email list. We send out content constantly. So look out for more videos. Talk to you soon.